We're here to talk about the Silicon Valley real estate marketplace. We'll get into the slide later on. Let's get into here. Here's the summary. We're talking about June 6th, Saturday. This is through Friday, June the 5th. I normally present the data that we were comparing it to on June the 6th. I don't have June the 6th data, so we're offset by 1 day right now. These are the key chapters we're going over. And the first slide we saw is chapter 4, which is how you control things. Let's get into the first data slides. Here's a summary of the marketplace. And what I've done is the far left-hand side here is the current market conditions. So basically you can see they're red to green. You get over here to magnitude of price reductions. They're on the blue side, so they're favoring the buyer a little bit. The frequencies on both sides, San Mateo County's got a fair amount of red. So when you look at the conditions in Silicon Valley, basically they're favoring the seller. If you look at the overbidding, that's very red compared to the left-hand side. But that's also a look in the rearview mirror by about 5 weeks. But it's also indicating that as of 5 weeks ago, buyers were still feeling a lot of pressure. But then if you look over on the green stuff that's not inside the red box, on the right side of the red box before the orange box, this is where it compares to normal. Normal is defined by me as the previous 10 years, 2016 through 2025, the median of those 10 years. What ratio are we, and is that good or bad? So you can see that here, even though the market conditions are still balanced to favoring the seller, they're much more favorable to the buyer than they typically are. So Silicon Valley is still a strong marketplace, but favoring the buyers more than it typically does. And the stuff over here in the brown box going all the way over the right side is useful information, but really doesn't tell you by itself what the market's doing. We'll get back into this later on. Here is a leading indicator. This is the number of offers accepted in the past 4 weeks. The blue line is 1 week, the green line is 2 weeks, dark blue line is 3 weeks, and the brown line is 4 weeks. So it's looking back in time for longer and longer. The reason I normally use 5 weeks is that takes care of a lot of the fluctuations that we see in the marketplace. The dotted line is that 10-year median I was talking about. The solid line is the current data. If you remember just about 2 weeks ago, and speaking of in the past, sorry about not having a presentation last week. I just had so many technical issues. It took me all week to get them squared in the way. Sorry about that. There will not be a posting for May 30th. Basically, around the 23rd of May, you were basically having absolutely normal volume of sales in the 1 and 2 week number of offers accepted. And I was basically pointing out that that's boding well for the marketplace. But now look at what's happened in the last 2 weeks. It's come down. I mean, you're now 1 week is quite a bit lower. 2 weeks is dramatically lower. Look at that difference. 3 weeks is dramatically lower, and 4 weeks is definitely lower. Now, 4 weeks and 3 weeks don't look like they're any further separated, so the slowdown appears to have happened over the last 3 weeks. What I noticed in preparing the data, there seemed to be, and I don't track it because it's too difficult, there did appear to be more transactions fall out of escrow last week than is normal. Volume of sales, this is sort of a leading indicator, right now is on a significantly downward trajectory. If this continues, obviously the market will slow. There's no way to know if it will continue or not, because just as I said, 3 weeks ago, we were basically right at normal. Here's a recap of some key indicators, and the key notes are we're taking 23% longer than we typically do to turn over the marketplace, but that's still 45 days or a month and a half. To sell out your entire inventory in a month and a half is pretty good, even though that's 23% longer than normal. Related to that is marketing time, and my marketing time is the 75th percentile, is 43% longer, so almost 50% longer than normal, but that's still only 25 days. That's 3.5 weeks. For the long typical seller to take 3.5 weeks to sell their property is still an aggressive marketplace. Price reductions, 1.8 times, just shy of double the number of price reductions you'd expect, but that's still only 1.1%. So just over 1% price reductions is double. So that's what that's saying is normally have about a 0.6%, 0.6% price reduction. Right now, you're almost double that at 1.2. We're at 1.1. And the reason that number, though, is so slow and really not a great number to look at is sellers and agents do their homework before they put their house on the marketplace. If the market's slowing, they already take that in consideration in their ask price. We've had a 15% shortage in offers. That back in 2023 was 30% less, 30% shortage. 2024 and 2025 was basically right at 20%. So if we're at 15%, even though you're still missing that 15% of the marketplace, it's less than it has been since the 2022 price corrections. we have a 10% surplus in the inventory. So buyers have a little bit more choice of homes, but not dramatically more. Buyers right now are overbidding on average 7.3%. That's a full 0.5% higher than the normal 6.7 that they're normally overbidding. And prices have been increasing as of a couple weeks ago. They do look like they're leveling off and most likely decreasing as they do every single year. Here now is going back over the past quarter. So in the center of the table here is basically this week, and it looks like I have this one off a little bit, but basically right where the purple line, the data line ends, is the current week. I go back 13 weeks. I go forward 13 weeks on the trend data. So the gray line is the 10-year median. The red line is the line that favors the seller the most. The blue line is the line that favors the buyer the most, and that's either the 10 or 90th percentile. So yes, you can go above the lines as we are basically doing right now on the turnover time, but that right now you're very close to equal to it. So only 1 out of 10 years are you taking this long to sell, but again, that's only 45 days and the 23% longer. Typical is 36 days. So you can see that you're longer than we typically are here in Silicon Valley, but still, is there really that much difference between 36 and 45 days? As long as you know what the market is, you plan around it, and the extra 10 days that it takes is no big deal. Marketing time, I use the 3/4 benchmark. 50% of the homes, I believe, basically sell that first weekend they're on the marketplace. So I'm looking at the 50% that don't sell and taking essentially the median of that, or the third quadrant, depending on how you want to look at it. It's the same number. A quarter ago, you can see that we were right at normal at 100%, and that was only 15 days. So in the last 13 weeks, we've gone from 15 days to 25 days. That's getting close to doubling of the marketing time in just 13 days. Or another way to look at it is you're picking up almost 1 day in marketing time for every week that's gone on for the past 13 weeks. And you can see that that's 43% slower than it typically is. Price reductions. You're on the downhill side of the blue line. So you're taking larger price reductions than the 90th percentile based on the past 10 years. You're almost double those price reductions, that 1.1%, almost 1.2%, typical of 0.6%. And again, the reason that's so small is the frequency of price reductions is very low. And so the sellers that have done their homework, price it correctly, and have put the house on the market at the right price, they don't have to adjust their price. So the frequency of those price reductions is pretty small. Ballpark 20% plus or minus 5% is sort of the range of frequencies. Overbidding, this is what the buyers are doing. You can see you're slightly above normal. In a competitive marketplace, we're at 12.5%. Right now, we're only at 7.3%, but typical is at 6.7%. In a slow marketplace, which keep in mind, we're still overbidding 4.4%. So it's almost insane to say Silicon Valley ever has a slow marketplace, that when we have those slow marketplaces, we're still overbidding 4%. That is for this time of the year. Obviously, if you go to a different time of the year, there's less aggressive overbidding. Offers accepted, you can see that we were approaching normal in the last 2 weeks. We have come down and we're right now right on that blue line. So if you look at numbers, 2,240, let's call it, 2,260 is the sluggish marketplace, the 90th percentile. So we're actually 1% below a sluggish marketplace. It depends on what's going to happen. Is this line going to come down and cross over and get very low? Is it going to rebound? You can see that we were approaching here 2 weeks ago. And because I adjust my data going back for 13 weeks, because there's a live databases that I use, the TFTs that I was commenting earlier that I think were higher than normal, and that's just observations as I'm processing the data, brought this line down from being very close to the typical line down. And that's also why this number is lower now. Inventory, that's the available listings. You can see we've had a surplus would be favoring the buyer. So we have more inventory, and we had that 10% more. And then number of transactions, these are actual closings. It's what the industry runs on. You can see that we're at 80% of where we typically are based on the past 10 years. Here now is looking long-term. You're going all the way back to 2016. So you have the whole 10 years. 9 of those years are on a condensed scale. Left of the green line here, vertical green line, is the condensed scale. You have a full year, 2025, on the expanded scale, plus the current year, 2026. The first line we're looking at is turnover time. So you can see that the turnover time was slower than normal just a few weeks ago. It was almost at 150%, call it 145%, and now you're down to 125%. So it's still slower than normal, but it's improving. Now you're going down to the orange lines, which is offers accepted, And again, you sort of see earlier this year, you were at 90%. You were at 90% even just 2 weeks ago, and now you're down at 85%. So you can see there's a fair amount of fluctuation. And this is using the past 5 weeks. So it is trying to normalize the data. I'm not looking at just 1 week period of time. And lastly, we're looking at active inventory. You can see the active inventory percentage of normal peaked out right about the end of first quarter, and it's been coming down. We went from 40% down to 10%. So yes, there's a surplus, but the surplus compared to normal is disappearing. Here's the control slide. So we're talking about the Silicon Valley real estate market. The last 8-10 minutes of the presentation is the Greater Bay Area. The reason I think it's important to pay attention to the Greater Bay Area to some degree is you want to know if what's happening local is a more global marketplace or not. Now, it's not going to impact your negotiations on an offer or your marketing value, but it gives you a feel on which way the market's going to some degree. And that's why I put it on there. The handout is posted. I got it up quite early this morning. So you can type in the blue link here, which is Google Drive, or you can type in the short green root URL plus letter H for handout 2026, 06 for the month and 06 for the day. Or you can just hit the QR code on the top left. Join the presentation live Saturday morning, QR code, the Zoom link, or the green root URL plus just the year 2026, the archive. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Here's some things that I do for customers that want to work with me. Customization, information. Basically, my job is to provide a service in a way that works for you, the client. Here's some metrics on definitions of the graphs that we're going to go over next. And here we are. So we've already talked about this graphic quite a bit. Silicon Valley is on the top line here. So you can look across the different metrics. Then you have the 3 counties, the 6 or 7 metrics, micro markets under each county. Some of the things I want to point out, look at Santa Clara County, 113% appreciation, but then look at each one of the micro market areas. None of them are significantly over 90, well, none of them are over 95%. So how do you get 113%? Look at where the activity is. You have less inventory than normal in the expensive areas, and you have 100 or greater than 100% of the number of offers in those expensive areas. So what we're having within Santa Clara County is a lean towards more expensive geographical areas, which brings up your median for the county without bringing up the median for any given micro market or any property values. That is one of the reasons it's important to look at micro markets. If you look at county sale price, for example, it's going to be this reported based on this 113. Well, it's going to be the 2,045,000 would be the median sold price. And that's going to sound like you've gone up 113% since 2015, but each one of the given areas has gone up by much less of amount. So that's why it's important to look at it. But the key takeaway we already talked about, sort of normal to favoring the buyer a little bit here. The magnitude of overbidding clearly favoring the seller, but that's a lagging indicator. But compared to normal, these dark green things were favoring the buyer. So we're slower than normal, but still aggressive. Here's the micro market area. This is the turnover time. So how long is it taking to sell over? This is the normal right here is completely balanced. The lime green up here is hotter than normal. The red is hotter than normal. The blue green is cooler than normal. And then the blue is even cooler than the blue green. So you can see you got some lime green here and some lime green. That looks like maybe a blue green in Union City and maybe a lime green in San Lorenzo. There's some variation, but the big takeaways out here in Livermore, Pleasanton, Dublin, Castro Valley, that's huge. I mean, they're taking 159 days and 166 days. So just look at the drop going over the Snow Pass. In Fremont, you're selling everything in 28 days. You drive over 680 and you're taking 166 days to sell your inventory. Talk about a contrast. 5 times longer just with a one pass in between the two areas. Here's the turnover time versus the 10-year median. So you can see across the board cooler than normal, except look, right where the expensive areas are, that's actually hotter than normal. That's why the median sold price in Santa Clara County is high. This is marketing time. This is how long is it taking 3 out of 4 sellers to sell. This is raw numbers. So now you got a little bit of pink. You don't have any outrageous red, but you got some blue-green. You got some lime green. You don't have any blue that I'm picking up right off the bat. So nothing's really cool. And you can look at the numbers. In Santa Clara County, you go from 17 days to 39 days. And in San Mateo County, you go from 16 days to 35 days. And in Alameda County, you go from 18 days to 35 days. Now, an observer might be going, wait a minute, how can you be selling 3 out of 4 sellers in 35 days and then be taking 160 days to sell your inventory one time? The difference is marketing time only includes the successful sellers. If a property comes on the market and doesn't sell, then it doesn't ever get reported as marketing time, and therefore it's not in this data. The turnover time counts those unsuccessful sellers. So the sellers that come on the marketplace and are inventory and never sell impact turnover time, but do not impact marketing time. Marketing time versus typical. Here you can see you're basically normal. You got some lime green, you got some dark green, you got some red, and you've got some blue. So completely balanced. If you look Silicon Valley overall, it's quite a bit slower at 42%, 43%. Santa Clara County is the county that's taking the bulk of that at 50% longer than normal. So it's actually surprising the graphs as optimistic as it is. I might need to adjust my colors. San Mateo County is the closest to normal at 110%, going all the way down to 78%. So faster than normal to up to a high of 120. And then Alameda County is a little bit slower than San Mateo, or a little bit better than Santa Clara, slower than San Mateo at 146%, with a range of what, 116% to 230. Price reductions. This is the difference from the price the seller first hits the market at to when they accept their offer. These numbers are small because so many of our sellers do their homework, so they don't do any price adjustments. So 2% is sort of the biggest I'm seeing, 2.15%. And that's right here in Santa Clara County. What is it? Saratoga, Los Gatos, and I mean, talk about extremes. The affordable areas in East Central South San Jose at 2.1%, and then the 2.15% is Saratoga, Los Gatos. You go over to San Mateo County, and the coast is at 2.17%. And those are the three high areas. And then you go to Livermore, Dublin, Castro Valley, and they're only at 1.5%. Look at the island of Alameda in the city of Berkeley. They're raising their price 0.25%. We'll see it in a second, but the overbidding there is insane. Here's the magnitude of that compared to normal. So now you're comparing it to normal, and very normal to less than normal. Look how blue it is on the map. Very blue, that means you got some green. So the best you're doing is normal. And I'm not seeing it. There's no reds over here, 101%, 99%, 98%. So right at normal. And then when you get down to 94, 95%, you're definitely some larger price reductions. This is the frequency. So I harped on this a bit earlier, but look at this. 13% is the low. The high is 27%. So 1 in 4 sellers are doing a price reduction. 1 in 3 out of 10 sellers in San Mateo County Coast are doing a price reductions. In Hayward, it's 1 out of 4. So basically, it's 1 out of 4 or less of the sellers are doing a price reduction, and overall, it's about 1 in 6. And again, you can see the different areas are, and they're next to each other. I mean, you go from red to blue, you go from light blue to dark blue, and that's why it's important to pay attention to what area you're looking in. Frequency compared to typical, definitely blue. Foster City standing out as the exception. I think there was no price reductions this week, but basically the blue indicates that you're having more frequent price reductions than we typically do. Overbidding. This is where the market still looks strong. Look at basically the graphs of pinkish color overall, and overall Silicon Valley's got 7.3% overbidding. Why? Santa Clara's at 4%. San Mateo's right near the Silicon Valley average of 7%. And Alameda County is coming in with 11% overbidding. And we'll talk about more than that later, if I remember. Now, what is the average versus typical? You have basically blue and green. So you're either having a normal amount of overbidding or less overbidding than you normally do. Here's the frequency of overbidding. So how common is the overbidding? 2/3 of all sellers in Silicon Valley is getting overbid. The lowest county is Santa Clara County. So earlier this year, Santa Clara County was outperforming San Mateo. Right now, Santa Clara County is the worst performing county. But basically 2/3, Saratoga, Los Gatos, only half the sellers get overbid. Look at the San Mateo County coast. Only 1 in 4 sellers get an overbid. In Atherton, 1 in 3. It ranges quite a bit. What's your high? Your high overall is Berkeley. 83% of all sellers in Berkeley and the city of Alameda are getting overbid. 80% in Redwood City. Frequency of overbidding in Redwood City that I just mentioned is 20% more. So Redwood City is normally aggressive in their overbidding. Offers accepted. You can see that we're at 84%. Santa Clara County is actually not doing bad at 90%. San Mateo County is at 100%. And Alameda County is only at 0.75%. So even though Alameda County has the most overbidding, which would suggest an aggressive marketplace, they're only selling 3/4 or 75% of the offers that they normally accept in. Active inventory. This is where buyers can find more inventory. Overall, you can see Silicon Valley is at 10% or more. Santa Clara County is at 18% more. San Mateo County is only at 8% more. And Alameda County, that had the long marketing time, is right at the normal level of inventory at 100%. I do not have micro market data for Alameda County. I'll probably bring that in the next couple of years as I have better data historically. Here's the appreciation. We already talked about Silicon Valley and Santa Clara County having 13% appreciation, and then the range. That's because, again, the expensive areas are doing better. This is simply where the expensive area, what areas have had the most appreciation. And basically, it's the areas where, when remote working came in place, lit up, which was Livermore. And then as people had to go back to work, the areas that have benefited the most long-term, or at least year to pandemic to date, has been sort of the closer in, affordable commute areas, but not in the prime areas like San Mateo and Los Altos. Here's the median price in the center. Unlike most people, I add in the cheapest 10 percentile and the most expensive 90 percentile in each range. So in Santa Clara County, you can buy a single family home from 1.2 million to 4.4 million. But now if you go into micro market areas like Gilroy, you can buy a home for 900,000. So that's why it's important to look at it. By giving you the sandwich, you have a range in each area. This we've already talked about twice now. Here's some definitions of what we're going into next. And basically what we're doing here is we're going back and looking at each metric over a long period of time. The micro market data is just current as of this week. This is showing you the trends. Again, we go all the way back to 2016 through 9 years, which was 2024 on a condensed scale, 2025 full year, current expanded scale, and current year. So you can see that the turnover time is higher than normal and climbing up. This dip down is just the holiday season, being Memorial Day. Going into a holiday, sellers don't come on the market, but the buyers still look. And so you have a decrease in the turnover time. After the holidays, sellers flood the marketplace, and buyers haven't had a time to make offers on the properties, those newly listed properties, and so your turnover time increases. You see that every holiday. And here's the turnover compared to normal, so you can see the bounce. The holiday moves by 7 days, Memorial Day, and that's why you have a little bit of a fluctuation. If you have a date that doesn't move, like July the 4th, you have less fluctuation on when you're doing the year-to-year comparison. Here's marketing time. So what is the typical marketing time for the seller? So this is the 3 out of 4 sellers are selling in basically 25 days, but you can see that it's been climbing fairly significantly since the midway through first quarter, and it continues to climb and is approaching the blue line, which is the most you'd expect. Here's compared to typical. Look at that rate of climb. You know, it's climbing, it's slowing down, but it's still within realm. But if you start looking horizontally, then in the past 10 years, 10 and a half years that I'm showing data for, it's not often you're more than 40% above the normal marketing time. So 40% is sort of the threshold where we're starting to get in rare territory. Here's the metric I like. This is looking at the sellers that do price reductions. It's looking at only the top 2.5% of the sellers on price reductions. And what are they taking? They're taking 12% price reductions. So now if you're talking about the typical $2 million median priced home in Silicon Valley, and you're talking about a 12% price reductions, that's $250,000. That becomes significant. But this number gets down to those earlier numbers that everybody reports, like the average, because so many sellers do their homework correctly, and half the homes sell the first week they're on the marketplace, so they don't have time to reduce their list price. So here's the average. The average is almost a factor of 10 lower. It's less than 1.2%, and we talked about it. Again, you can see it's below the blue line. This is a time of the year where sellers continue to take larger and larger price reductions. Basically, now through the end of the year, you can see right here at the end of the year, there's a little anticipation, and it comes in before the bottom of the year on this one, because sellers are going, well, the market's about to improve. I'll just wait and let the market catch up to me. And so they become less inclined to do price reductions. And then you go into the first year, and you have the first of the year, and you have all the new inventory coming on, and the price reductions go way down. Real estate is very cyclical. Each metric has its own cycle, and that's why I do a 10-year comparison. Here's that 10-year comparison. You can see that we're cooler than normal. Blue is always cooler than normal. Here is the frequency of price reduction. We talked about it. Only 16% of the sellers are doing price reductions. That's not very many. That's not a very high percentage at all. we're only at 16% of the sellers are doing a price reduction, and you can see that's climbed up quite a bit, but it's still a small percentage in the marketplace. I will point out the highest that we got up to is 35% of the sellers, so that would be 1 in 3, and we're right back here in the worst price adjustment period I saw, which was right after the 2022 price adjustment. Only a third of the sellers were doing a price adjustment. Here is the price adjustment compared to normal. So again, you can start seeing we're getting in the higher atmosphere. There are times when you've had higher back in 2022, 2023, when we were going through that price adjustment. But look at the 2022 price adjustment. You're down here from 20% of the sellers were doing price adjustments. So 1 in 5. And then you went all the way. Well, this is compared to normal. So you were doing 1/5 of the price adjustments that you normally do. So if it's normally somewhere around 17%, that's not a bad number. It might be closer to 15%. You were down here and only 3% of the sellers were doing a price adjustment. And then boom, what is that, a quarter and a half later, you were double that. So you went from 3% to 30% if your typical is 15. And that's probably a pretty accurate representation of what actually happened. But then again, look at the improvement coming into 2023, dramatic when it happens. So, these large long-term shifts are not uncommon. Here's the median overbidding. And again, I said median. It's the only slide in my presentation that talks about the median, I believe. You're basically at 3.5%, just over 3.5%, maybe 3.6%. Overbid is where half the buyers are coming in over 3.6% over the seller's ask price, and half are coming in less than 3.6% over the seller's ask price. Here's compared to normal. So you're a little bit more aggressive overbidding than normal, a little bit more frequent, and that's back to average. This is the frequency of overbidding. Right now, you can see you're about 66% of the sellers are doing overbidding. So normally you're up here around 72%, 73% of sellers getting overbid. So you're less than normal, but you're sort of following the normal pattern. You were closer on the way up, but you're not that far off. Frequency of overbidding, it's 90% of where it typically is. So you can see that we've been down. We're up for quite a bit from just last year. Last year at this time, we would have been right about here because we're not quite to second quarter. We got the worst we were was, middle of August, third quarter starts July 1st. Offers accepted, you can see, look at the dramatic drop this last couple of weeks. That's what's got me probably paying attention. Is that going to continue? Is it a fluctuation? Is it the fact that we're on June 6th? And so right now, this weekend, last week from June 1st through June 6th, we had a flood of new listings come on the marketplace, and the buyers haven't had an opportunity to get them accepted yet. I would have thought that would have happened already. Right now, it's something I'm paying attention to. If we drop again, not to sensationalize it, if you look at the peaks happen right around Memorial Day and it comes down. So is this just that Memorial Day was a week early? It was the absolute earliest it can be on the 25th. Active inventory, you have a little bit more active inventory, but you're not really growing, and the active listings isn't that outrageous. So what was it, 10% more? So it's a little bit more choice, but not much more. Here is the price, and I'm doing 3 different models now. The low end, and I probably need to inflate this a little bit, but the low end seems to be a slight downward trajectory. The median seems to be on a very slow upward trajectory, and the higher price homes are actually on the steepest upward trajectory. And I just thought that was interesting. Yeah, you could level this off. You could do anything you want, but I think this is showing you on how differently the markets are performing. We also saw that with Los Altos doing very well in Santa Clara County, where some of the other areas are not doing so well. And that's why there's such a high appreciation as the market mix has shifted. Here's some definitions of what we're going over next. And now what we're doing is the same metrics, but we're comparing the 3 counties. So all 3 counties are having an increasing in marketing time. San Mateo County is the fastest. Alameda County is the slowest. This is telling a time to sell, the typical seller. All of them are climbing. All of them have been climbing since middle of first quarter. We're still very reasonable. All 3 counties are somewhere in the 20s. Ask price reductions, all 3 counties going down. Look at Santa Clara County. It's dropping significantly more than the other counties. The other counties have gone from 95.5% to 99%. Santa Clara County has gone from 99.5% to 98.5%. So Santa Clara County has gotten basically double the price reduction, and that's the average. Frequency of price reductions, all of them are increasing. Santa Clara County has the highest Frequency of price reductions now at just over 20%. Overbid. Look at Alameda County up here by itself at 11% overbid over the seller's ask price. Santa Clara County is the least at only 4% over. So Alameda County has tripled the overbidding of Santa Clara County. Frequency of overbidding, here we're fairly close together from 63% up to 70% of the sellers getting more than their asking price. Alameda County's got the most, Santa Clara is the least. Offers accepted, look at them, all three counties are down. That's why I'm wondering if we're going to see a turnaround next week. I would have expected the turnaround this week, so I'm a little bit concerned. You know, we had an election this year, you know, nothing, it's only a primary. Did that distract buyers so that they weren't busy looking at houses? You know, any social event, anything that attracts people's attention, real estate's the last thing they do. So it could be as simple as that. Active inventory growing, very similar in Alameda and Santa Clara County, typically have the most just because the size. San Mateo County is very reasonable, but smaller in size. Appreciation, Santa Clara County has the most. We've already explained why. Alameda County and San Mateo are very close together, and that's about where Santa Clara County would be if I did a weighted average of each one of the micro market areas to get rid of the market shift. Median sold price, San Mateo County's got the highest, Santa Clara close behind. Alameda County is clearly the more affordable of the three counties. Sold price on same information, just on regular paper. The previous was on log. Here's your payments using the high balance conforming loan limits. So you can do better by using jumbo money and by getting relationship pricing. You can see I'm doing the price payment because that impacts the value in a lot of people's minds more than the actual price. Here is something very noteworthy. We've talked about the volume. Last week we were the sixth. I didn't report last week, but we were the sixth out of the last 10. So 4 counties were less. For 4 years performed worse than we did last week. This week we're the second worst. The only year that did worse is 2023. It says 2022 up here, but the year changes right here on January the 3rd. So it's 2022 from here up and 2023 from that line down. And on July 1st, basically it flips over and all the years advance. But we're only at 2239 and we were at 2150, 2050. So, you know, we're not going to become the worst year, but, you know, that was 2023, which was right after the correction. So to be, you know, we were actually doing worse than the pandemic. You know, now the pandemic in 2020 was already recovering, and that's why these numbers are crossed out. They were artificially the worst. But I mean, that's significant. You went from the 9th, and let's talk about you went from the 21st worst year to the 24th worst year. So being the 24th worst year out of 25 as far as volume of offers is noteworthy. I'm sorry, it's noteworthy. Here's the raw counts for Santa Clara, San Mateo, and Alameda County, or Silicon Valley overall. You can pick your metric down the left-hand side. There's 2 different levels of appreciation, one since 2020, since the pandemic, and you can see those numbers here where Santa Clara County's got the highest at 49%, and then it's also got the highest since 2015. Here's some definitions for the 3 metric distributions we're going over next. The first one is marketing time. We go from the 50th percentile up to the 90th percentile. We start on the dotted line a year ago. We end up on the purple line, which is the current data. Let's step through. You can see that we're immediately increasing. See how the dotted lines are going up towards the blue line up here? So that means you would expect longer and longer marketing times. Now it does a little bit of a plateau and then it continues down in a little bit. That's still there and it's starting to go down. So there's a little improvement right there at the beginning of October. There's probably the bottom. And now November, it's slowing down for the end of the year. So between now and basically September, you'd expect longer marketing times. You're coming up right there on the slowest year, January 10th of the following year. Look how steep it's getting on the right-hand side, and now you're bottoming out. You're already decreasing. So the fastest marketing time is right around the beginning of March, and now you're continuing to march up, and we're going to end up on the purple line in a couple seconds here. And there's the purple line right there. What's that telling you? You expect longer and longer marketing times going forward. Doing the same concept now on price reductions. Here, though, we only go from the 2.5%, the 97.5 percentile, the largest 2.5, down to the largest 17.5. So I'm looking at only the top 15% of the marketplace shifted down by 2.5% to get rid of the oddball people. Same concept. You're starting on the dotted line, so we're taking less price reductions this year than we did last year. That's noteworthy. But notice the direction of travel. it's going downward. So there's worsening because you see the blue lines down here. So that was probably right around the middle of July was sort of the largest price reduction. So we're not that far away. We're about a month away. Then it hits that plateau. Then there's the improvement in September and October. And then when you get to November, it starts going down for the end of the year. It turns around a little bit earlier. Right there's probably the worst. Yep, the 13th of December, because people are anticipating the run up for the next year. And right about there is your peak on February 21st. So again, what you're expecting near term is larger and larger price adjustments in the downward direction as sellers go into the cooling part of the year. Silicon Valley takes two incomes to buy a house, and that's what drives the marketplace. Now we move on to the third and final distribution. This is overbidding. It goes all the way down to 5%. So 5% of the sellers are getting currently 40% more than their ask price. 15% of the sellers are getting more than 17.5% over their ask price, all the way down to 59%, probably, maybe actually closer to 63% of the sellers are getting more than their ask price. About 10% are getting exactly their asking price at 100%. And 25% of the sellers are getting less than their ask price. We're starting off a year ago on the dotted line. So you can see overbidding is higher on the purple line this year than it was last year. Starting off on the purple line, let's see which way this goes. It could go either way at this point. It looks like it's a plateau and then down. So one more week and then we start going down on the amount of overbidding. And this is both the frequency and the magnitude because it's a complete distribution. Right about there is the bottom on August 23rd, but remember that lags behind, and then it starts improving with more aggressive overbidding. And probably right around November 1st, November 15th. November 15th was the peak, and then it cools down for the end of the year. And this probably goes until January 31st, and we don't have the 31st, but the 24th right there. Yep, so the 24th of January, then it starts improving. And it's already come down because there's about the peak. Right there, April the 5th is the peak for this current year, and now you're cruising down to the purple line that we've already seen. So what do I expect? I expect roughly the same, maybe a little bit lower, maybe a little bit higher overbidding next week, and then downward for the next several weeks after that. Here's moving on to the Greater Bay Area, 5 regions, 13 counties. Here's some definitions. The purpose of this is not to follow the market in this Greater Bay Area region, but to have a grasp, high-level understanding to see whether Silicon Valley is unique or if it's the bigger area that's being impacted and how they're being impacted. So here you have the 5 regions. You have the purple in Silicon Valley. The orange is the city, San Francisco and Marin. The blue is the Central Coast. The yellow is the Central Valley, and the brown is North Bay. What we're looking at here is the turnover time. I would say the turnover time is sort of a mixed bag. It's clearly going down in the Central Valley, probably had been going down, but looks like it's now flat in the North Bay. And the remaining 3 areas, the Silicon Valley, the cities, and the Central Coast, are all having longer and longer marketing times, but only for a couple of weeks. Before that, they were pretty flat. Time to sell. This is the 3/4 seller. I would say across the board, they're all going up. Yes, you had a little downturn in both the Central Valley and the Central Coast, but I think that's more anomaly than anything else. The other 3 are clearly in the upwards direction. I think this anomaly could be tied to the holiday. Here's ask price reductions, increasing price reductions across the board, all 5 regions. So clearly the market's cooling, or sellers thought the market was improving when it was flat. There's an increasing discrepancy between the buyer's expectations and the market reality, and causing them to do more price reductions across the board. Here now is the frequency of price reductions. Again, they're all increasing. Yes, there's an exception in Santa Cruz and Monterey, the Central Coast, this past week. But again, I would say that's probably more anomaly. You can see that there was one here and even another one back here at the Valley. The general direction's up. When you have smaller areas like the Central Coast, Marin, San Francisco, then the data becomes more susceptible to fluctuations. Here now is the overbidding and the magnitude. Cities by far has the most overbidding at 16%. Silicon Valley, then it's about 7.5%. And then the remaining 3 are pretty close to 100%. You have this North Bay at about 1.25% over ask price. Central Valley, maybe 0.25% over. And the Central Valley at about 0.25% over. The Central Coast at about 0.5% under the seller's ask price. But the direction on all of them is basically fairly flat. Yes, there's movement every week, but I would say that near past term trend has been flat. Here's the frequency of overbidding. I would say that this one is going down. It's definitely down in the Central Coast, down in the Central Valley, down in the North Bay, down in Silicon Valley. You might argue that it's flat in the cities area, but it's clearly rolled over from its previous increasing. Number of offers accepted, down in Silicon Valley, flat in North Bay, up in Central Valley, down in the cities, and flat in the Central Coast. So what would I say? I would say we're either flat or we're going down. The closer you are to Silicon Valley, the more the downward pressure is. Active inventory is increasing in all the areas except for the cities. Cities, I would have to say the inventory is flat. The other, and it may be even flat here in Silicon Valley. The other three are clearly still increasing. The Central Coast, these two are down here because they have smaller geographical areas. Central Coast, Central Valley, and North Bay are clearly increasing inventory, active inventory for buyers to purchase. Here's appreciation. Silicon Valley has the highest appreciation rate, and I've already shared multiple times. That's the market mix that's going on and causing that to be the highest. Then you have Central Valley, then you have Central Coast, and then you have a two-way tie between North Bay and the cities. I wouldn't be able to really pick a trend. I would say the trend is it's flat, but these two are clearly up. The other three are flat. And those are the two that are clearly up are the cities and the North Bay. Now we have the sell price. Cities, being San Francisco and Marin, is clearly the highest and clearly on a fairly steep climb, especially this year. It's climbed up fairly dramatically. Silicon Valley has climbed this year, but it's been making up what it lost. It's basically the same level as it was before, where the cities is coming back up. But the other thing that's noteworthy is the cities is now very close to its peak. Silicon Valley is at or slightly above its peak. Central Coast is still below their peak. The other two are very close to their peak. I would say all five regions are getting very close to their previous peak. The prices are basically flat for the most part, and they've been flat since the previous peak was first hit back in 2022. Prices have been basically flat. I expect that these will roll over, especially the cities. It's out of line where it's been here, whereas Silicon Valley is more sustained by where it's been the last couple of years. Here are the same order. This is the monthly payment, so you add in the interest rate based on the high balance conforming loan limits. You can do better by doing a jumbo loan and also by having relationship pricing, but it gives you an idea what the payments are based on an 80% loan, property tax and insurance estimates. Here's the raw numbers. The now column right here is the current week. This is the change in the metrics since 1 week ago and since 5 weeks ago. You have the 13 counties down here in regular font, intermixed with the 5 regions that they represent in the bold. I have a bonus region of Bay Area. I do that because the media talks about it. And then across the top, you have your different metrics: the turnover time, the time to sell, price reductions, price reduction frequency, overbid magnitude and frequency, appreciation, and the pricing and appreciation. So here are my weeks that I use. We're basically here on June the 7th. The reason I'm using June the 7th is that's my calendar year. I start on March the 1st. I go forward 7 days at a time. In a non-leap year, you end up on June the 7th. I am reporting this on the 6th, so this is actually data as of midnight, June the 5th, back through May the 2nd. So there's a 1 day discrepancy in my reporting. That 1 day discrepancy goes away next week when I update, because I update for 13 weeks to try to get as much accurate information as I can. So every week it gets more and more accurate because there's fewer transactions that fall apart. But for the first week to report on Saturday, so that I'm grouping the previous week's data together, there's a 1 day discrepancy. I will do a 2 day discrepancy next year and probably even a 3 day. Once you start getting into 4 days, and more importantly, the days of the week, the data becomes a little changed. So I will probably back off and just report the accurate data. I haven't made that decision yet, but there's a lot of activity that occurs in the field on Saturday and Sunday, but there's very little reporting back office reports of sales and offers accepted, et cetera. And there's no closings. There are closings that are reported and you don't know what day they occurred because they clearly do not occur on Saturday or Sunday. But these are the 52-week pattern that I use. It's all based on starting on March the 1st so that you have one discontinuity. There's 1 extra day every year on 2 extra days on leap year. Leap year are the 5 lines here that are highlighted in yellow. And with that, we've been talking about the Silicon Valley real estate market and the greater Bay Area. 75-page handouts available. I'm Richard Calhoun, real estate broker with Creekside Realty. You can hit the QR codes for the handout or the join Saturday morning live and or the archive. Thanks for watching. Take care. Bye for now.